This video is brought to you by Skillshare. The first 1,000 people to click the link in the description will get a totally free trial of their premium membership.
Once again, we have socialized an industry's losses and privatized its profits. Basically, what the government did was bail out
I know we bailed out a lot of folks in the airline industry, but think about the restaurant industry. Nothing was done for these people.
Broadly speaking, a bailout is to provide financial assistance to an entity about to fail. And yes, in recent history, the US government has stepped in a few big times to save the day.
Lehman Brothers filed for bankruptcy.
It would have required an $85 billion subsidy to keep afloat.
Because you see, sometimes the crisis may come from a specific industry or sector of the economy, like the housing market crash of 2008, which ended up blowing up on Wall Street, when the government has to refill the banks or financial institutions with money to keep the system from going down. That is referred to as a corporate bailout. And it's not a popular move by any means.
Tear down this wall before the American people do it.
Yeah, you're gonna get acquainted with economic recessions as you grow old and live through one or two. It is when economic and social events escalate to a tipping point and the economy starts to decrease. And you know who always gets the worst part of it? It's not the big bankers or the corporations. It seems like when they lose, the government comes to the rescue. They're too big to fail in a way. But even when the crisis is not about the bankers' greed, even when it's something like a pandemic virus, the big players still manage to get the best of it. But the massive scale of the latest money injections has been staggering, and you may have some questions around the topic, just like us. Probably the first one is, where does the government get all that money from? And where does it go? Does it really help those most affected, or does it just save a high-stakes gambling game in the economy? Let's talk about bailouts today. When do things get so bad that the government needs to step in? Current times are a great example. In fact, the largest economic intervention by the US government in history is undergoing as we make this video. Although some cities seem to be getting over COVID these days, the truth is that it has been ruthless. Hospitals collapsed and businesses of all kinds were shut down for months, leading to record unemployment rates and a deep economic recession. So in March this year, the US Congress approved the American Rescue Plan Act, or ARPA, which consisted of a massive $1.9 trillion package to support public health and different actors across the economy, from businesses to individuals. And only a year before, when the pandemic was only unfolding, the former president, Donald Trump, had approved the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act. It was a historic $2.2 trillion stimulus and bailout package. So the US government pulled off more than $4 trillion to re-inject into the economy in only a year. That's around 20% of America's GDP. It's about 2 times the value of Apple. It's ridiculous. So where do they get all this money from?
For many of those struggling Americans, likely a sense of relief tonight.
93% of American families covered by that.
I never signed anything with a T on it.
There's no simple answer to that, but there are different mechanisms that federal authorities use to keep the economy afloat. In the US, the main institutions involved are the Treasury Department, which collects taxes and manages public funds, and the Federal Reserve, which is the country's central bank. And these two are the ones that can create money, particularly the central bank. And then finally, they need to get their monetary policies approved by Congress. The Treasury and the Fed share 3 major mandates: maximizing employment, stabilizing prices and inflation, and monitoring interest rates. And to do this, they control the supply of money that circulates through monetary policy. That means they can create or restrict money in order to keep things balanced. And it's no longer printed money. So forget about those old images of, printers churning out bills. Here's where things get complicated, so let me refresh the basics. For starters, a security is a financial asset that can be traded. 2 of the main security categories are equity, like stocks, and debt securities, like bonds and mortgages. These are financial assets businesses can use to raise capital. Just like stocks are sold and traded in public exchanges, there's also a public bond market. And it may not be as cool as the stock market, but it's quite larger, actually. And it's where most of this bailout action happens. The bond market is made up of issuers that can be corporations, public entities like municipalities or federal agencies, looking to borrow money from investors. And they do it by issuing and selling bonds. So let's quickly try to understand bonds. A bond is essentially a loan. Banks and financial institutions can raise capital in the bond market by issuing and selling bonds. So the bonds are IOUs, or IOU certificates, which is basically a promise of paying the money back. There are different bond denominations ranging roughly from $100 to $5 million. And when an investor, that can be another bank or an institution, buys a bond, it essentially loans the money to the issuer. For the investor, the bond is the promise of getting the money back plus some gains over time, aka interest. And the maturity of the bond determines the time in which the issuer needs to pay the full amount back. So there are short, medium, and long-term bonds. But who ultimately runs the market are the Treasury Department and the Federal Reserve. The Treasury collects taxes, but it also raises capital by issuing bonds in the market. This way, they may finance public projects like infrastructure spending, or they may also control the money supply. How? Well, we're getting close to that money creation part. So the Treasury regularly borrows money from the market through these bonds. But when the economy needs to be rebalanced, it's the central bank that goes out to the market and buys those Treasury securities back from the banks and institutions that hold them.
But the bond market investors, they're thinking, are you nuts?
We'll continue our bill purchases, at least into the second quarter.
By buying mainly short-term Treasury bonds, the Fed injects money into the banking system with the intention that there is more money to loan to the public at lower interest rates. Lower interest rates means that borrowing money for people and businesses is cheaper, and this helps keep the economy active. These money-creating interventions are known as open market operations and are considered conventional ways to keep the economy balanced. But open market operations haven't been enough to face the latest crises. So the Fed goes further by implementing unconventional methods, which are known as quantitative easing. No need to get technical. Let's just say that QE is a more aggressive intervention by the Fed in the securities market to buy not only Treasury bonds, but also other riskier assets like longer-term bonds, corporate bonds, mortgage-backed securities, as well as a special loan program for the banks.
We will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month.
Riskier means that those assets are backed by debt that is likely not getting paid. And you see, risky assets like mortgage-backed securities were at the very heart of the 2008 recession. That's a whole other story, and we can make a video about it if you want, so just let us know in the comments. Back then, all the Wall Street banks and financial institutions all found themselves holding tons and tons of toxic assets in the form of mortgage-backed securities that weren't getting paid. Why? Because they had been pumping mortgages in the housing market, taking high risks with the loans, and making equally high profits selling and reselling the mortgages in the securities market. It was this wild chain of speculation that fed Wall Street's guts for years. And that's why those bailouts were so unpopular. The public perceived it more as a saving greedy bankers than a rescue of the economy. But the reality was that the banks were all on the verge of bankruptcy, threatening to leave the country without cash and cause economic distress globally. Like it or not, if the government doesn't do it, then the financial system might collapse and bring the whole economy down with it. Even the president back then, George W. Bush, who was a firm believer of free markets, was reluctant to collaborate in the bailout at first.
I didn't come to Washington to bail out Wall Street, I didn't either, but, it's necessary.
Through our new TARP authority, Treasury will purchase preferred stock in each of the banks represented in
the
this
Treasury and the Fed came up with the TARP Act, or Troubled Asset Relief Program. It consisted of massive QE operations in order to buy hundreds of billions of dollars of bad assets from the banks, re-injecting them with more than $700 billion. Approving the 2008 legislation was not easy. There was opposition on both sides of the aisle in Congress, and some Republican representatives called it a slippery slope to socialism. Let's try to see if the controversial 2008 bailouts and the COVID relief programs are any similar. In the end, both times, the government has engaged in QE operations to inject massive amounts of money into the economy. Broadly speaking, the COVID relief packages were more social interventions than just financial, and required larger coverage. They do contemplate funds for public health, stimulus packages for individuals and families, forgivable loans, and tax cuts for small businesses. Back in 2008, no money went to individuals or public health or small businesses of any kind. It was an injection of hundreds of billions, all distributed among the main Wall Street banks to buy toxic assets back from them and save their system. And it must be said that the majority of the funds that were given have already been repaid, even generating margins for the government. The TARP was a successful program of money injection that managed to keep acceptable inflation rates. Still, the 2008 crisis had irreparable consequences on the public trust in the system. People felt like their money, the public funds of the state, was being used to save greedy bankers. It caused social unrest, heated protests against Wall Street and the government, and there was little authorities could do to change that perception. Back to today, the COVID relief interventions were approved in Congress with a sense of urgency for the most part. But some did raise their voice to claim that these relief programs came with probably the largest corporate bailouts in U.S. history, too.
There should be shame about what was fought for in this bill and the choices that we have to make.
Yeah, forget about the stimulus checks for a moment, because the truth is that more than half of the relief funds, over $2 trillion, went to businesses, according to the Washington Post. That includes, again, hundreds of billions for large corporations and market stabilization operations like purchasing corporate bonds, mortgage-backed securities, and other risky assets in quite similar fashion to 2008. But the truth is that even before COVID, corporate debt was already at a threatening record level. So a lifesaver for the corporate sector may have been in order. According to CNBC, corporate debt today stands beyond $10 trillion, which can be perfectly a time bomb. And if you have learned anything today, it is that poorly managed debt in the corporate world can blow up the economy. So while a good $500 billion went to aid big corporations, small businesses got a few $100 billion less in lending programs that have been widely criticized for failing to reach those most in need, the smaller ones. Smaller businesses have been required to keep all workers on payroll in order to access the funds, while other larger businesses haven't. One last thing to remember from all of this is that there is a very delicate balance between how much money the government can create to keep an economy from a recession, but without overflowing it and causing other unwanted outcomes like inflation. Inflation is one of the main concerns that emerge after the central bank performs these money-creating stunts. It's the risk of essentially having too much money out there, chasing too few goods, making money lose value and the cost of life go up. And yes, consumer prices are surging in the US, more than 4.2% in April 2021, the most in any 12-month period since 2008. Have you seen any long lines to buy gas and stores out of lumber? Well, it might be a sign of the times. Officials from the Fed have said they were surprised, but they hold their ground and are confident that they will keep inflation at the expected 2% rate. But many are already ringing inflation bells.
We're raising prices. People are raising prices to us. It's being accepted.
And if you think that an economic recession can affect you directly, you're right, but you can prepare for it. And Skillshare is the learning platform where you can take classes for things like preparing financially for an economic crisis. There are hundreds of finance and economic courses that you can get real value from. We usually talk about starting up your own business through venture capital and investment, but small businesses and entrepreneurs can also raise capital through debt financing. You can learn how to fund your business by borrowing money and do it right. David Haber is a founder and CEO that can introduce you into debt financing for entrepreneurs, and it's quite interesting. And of course, there are plenty of courses in other areas like web development, design, video production, and much more. The first 1,000 people to click the link in the description are going to get a free trial of the Skillshare Premium membership. So we would love to hear what you think, and we hope that you liked this episode, hopefully learned something. Please let us know in the comments, and we'll see you next week.